Today, CFS meets Norman Milner, portfolio manager of Neuberger Berman Global Credit Long-Short Fund. Good morning, Norman, and welcome to Milano.
Good morning, thank you.
How does a long-short credit fund work, and which are the key points of your strategy?
Thank you, good morning. A global long-short credit fund is a fund that invests in the fixed income markets globally and takes advantage of the fundamentals of the businesses we want to invest in. What that means is that we are expressing a view on companies that we think are undervalued or parts of the company's capital that we think are undervalued, and we are also taking advantage of companies that we think are overvalued. The fund works to give investors a return from fixed income without exposing them to the direction of the market and without exposing them to the direction of interest rates. So it's a way to take advantage of fixed income without being purely just long only.
And considering the traditional Italian preference for fixed income allocation, what role should play your long-short credit fund in their portfolio?
So that's obviously a very important question, not just for Italian investors, but for investors globally, but in Italy in particular, as you've said correctly. Investors in Italy face a huge challenge because interest rates globally are very low. So the return from fixed income is very low. Approximately 70% of global fixed income trades at 1% or below. So what is important for investors in Italy in particular is to think of this product as part of their traditional fixed income allocation. Because interest rates are so low and because credit spreads are so low, the risks in the market have gone up a lot, and we think it's important to be able to be both long and short, take advantage of opportunities without having to just be exposed to the market. So this is a very good complement to traditional fixed income.
And which macroeconomic factors and which indicators on the main markets influence your recent investment strategies?
So obviously the macroeconomic environment is very important. The things that we are focused on most at the moment are clearly, number one, the actions of the Federal Reserve and the idea that interest rates in the US may begin to go up. Traditionally, our fund has done very well in a rising interest rate environment. The second thing that for us is important to consider is the fact that the European Central Bank is now actively involved in buying corporate bonds, and this creates a distortion in the market and changes valuations. So we are very focused on looking at ways to allow investors to share without the downside. Obviously, global growth is very slow. Obviously, there are risks both in China with what's going on in their economy. And the last really important macroeconomic stabilizing factor to think about is the fact that as the Federal Reserve begins to raise rates, this has lots of implications across the board. So we really focus on that. But the last, and perhaps for us as fundamental investors, the most important thing is that all of these factors are beginning to really influence companies' earnings and returns. And those are the factors we're looking at.
Something more technical. According to the fact sheet, at the end of April, the fund was net long for approximately 59% on the portfolio. It's common to have a directional position or no?
So that's a very important point, is that when you look at the fund, looking at just one number, as you just said, gives you a good sense, but it's important to look at also all the underlying details as well. When you look at the fund at the end of April, you will see that we had almost no interest rate exposure and no credit spread exposure. So typically, the month of May has actually been a challenging month for the markets so far, and yet our fund has actually managed to make money because even though we look like we're net long, a lot of that is cash that we've actually invested in some very safe and secure assets to help us pay for and to supplement some of our shorts. So it is important when you look at our fund to consider the philosophy of what we're trying to do, and the philosophy is as follows: continue to generate returns from fixed income without sharing in the direction of the market. So if you look at January and February, which were very difficult months for the market, we did not go down as much as the market because we were defensively positioned. And now that the market is beginning to recover, we are recovering with the market. So all of these factors, including positioning, philosophy, macroeconomic, as you just pointed out, are really important to understanding how we do this. We think this is a very exciting time for our strategy. We think this is the correct time for it. And we hope that investors think about this with a lot of consideration.
Thank you very much, Norman, and see you soon in Italy.
Thank you, and I hope you invite me back.
Thank you.
Thank you.
Bye.